There is a 60-day clock running in Tehran right now, and this is the first full week it actually ticks. There is a board vote in Astana tomorrow morning at a company that controls a fifth of the world's uranium. And there's a fuel deadline at the Department of Energy that almost nobody is talking about. No big earnings this week. And that is exactly why this week matters more than it looks.
Yeah, I mean, it is the absolute definition of a market just holding its breath,
Right?
right? Just waiting for a geopolitical shoe to drop.
Right. Well, welcome everyone to the Uranium Unleashed Week Ahead Deep Dive. It is Sunday, June 21, 2026. And if you are joining us, just consider this your shortcut to cutting through all the noise of the upcoming week.
And there is a lot of noise.
There really is. We're looking at a market where the headlines seem quiet on the surface, but the underlying mechanisms of global supply are moving incredibly fast. So, Host B, what kind of week are we entering?
So we have to connect the dots between governance, geopolitics, and how that impacts uranium pricing. Because the big producers, they do not report this week.
Right. I mean, Cameco isn't until July 30th.
Exactly. Cameco's July 30th,
Yeah.
Paladin's June quarter numbers come in July 2. So nothing this week is going to be driven by an earnings print.
Okay, let's unpack this for the listener. What's the distinction here? Because if it's not a numbers week, what is it?
It's a signals week. In a numbers-driven market, algorithmic trading dominates, right? The company drops a spreadsheet, a machine scrapes the revenue beat or miss in like milliseconds, and the stock reacts.
Right.
But in a structurally quiet earnings period like we have right now, the algorithms lose their edge. It's entirely driven by what government officials say or what corporate boards imply.
The subtext.
Yes, the subtext.
Yeah.
Human traders have the edge here because an algorithm cannot read the subtext of a diplomatic memo. Yeah.
And that brings us to the diagnostic question for the whole week. Are we basically trying to figure out if the recent geopolitical calm in the Gulf will bleed into the uranium term curve?
That is the exact question. Will it bleed into the term curve, or does it stop at the spot price?
Right, which we will definitely get into. But first, let's look at the hard calendar. We have 2 confirmed pin dates. The first one is Kazatomprom's extraordinary general meeting in Astana.
Yeah, the EGM. That's Monday, June 22nd at 10:30 local time.
And if they miss quorum on Monday morning, the meeting automatically rolls to Tuesday the 23rd, right? So keep that on your radar. But on paper, this sounds like an incredibly dry procedural event.
Oh, it sounds so boring.
Yeah, it's just a board re-election. So why is a boring procedural vote at a company that controls, roughly 22% of global primary production? Why is that a massive potential catalyst?
But because you do not watch the agenda at an EGM like this. You watch the off-agenda chatter. And the board re-election itself is basically a non-event. They'll get re-elected.
Right.
But Kazatomprom is the largest producer on Earth. So if a re-elected director just casually drops a hint on the 2026 output trajectory...
Tracking against that first quarter figure of 6,144 tons of uranium.
Exactly. If they talk about that, or if they reaffirm their value over volume posture, that is the signal we are looking for.
It's like analyzing a poker player's casual conversation for tells, right? You're not looking at the cards they play. You're listening to how they talk about the game.
That is a perfect analogy. And the biggest wild card in that game is China.
Oh, wow, right. Because about 60% of Kazakh exports go to China under those government contracts?
Yeah, 60%. It's massive.
Yeah.
So any subtle shift in how they allocate output between China and everyone else, that speaks straight to how many pounds are actually left for Western utilities.
So wait, what if they actually signal a production cut? Just hypothetically.
If they signal a cut or even just more discipline, that is wildly bullish. But if they signal deeper Chinese commitments, that's quietly bearish for Western buyers because it means less supply for them.
Got it. Okay, the second pinned event on the calendar is the Sprott URNM ETF rebalance. That takes effect at the start of this week, stemming from the Friday, June 19 effect.
Yeah, so they moved their semi-annual index reconstitution to June and December.
And this is what we mean by plumbing versus fundamentals, right?
Exactly. This is pure financial plumbing. I really want to warn the listener here. If you see a single stock jump or drop wildly this week and there are no headlines...
It's probably just index flow.
Yep. It is mechanically forced buying or selling to match the new ETF spreadsheet. Do not invent a fundamental thesis change where there isn't one.
Okay, so that's the hard calendar. Kazatomprom, EGM, and the URNM ETF plumbing. Now let's move to the expected and developing stuff. The unpinned catalysts.
The stuff lurking just under the surface.
Exactly. Let's start with the Department of Energy's HALEU deadline on June 30th. Congress gave the DOE a hard statutory deadline to make the final 10 metric tons of high-assay, low-enriched uranium available.
Which brings the total to 21 metric tons, yeah.
Right. And we've seen previous rounds with names like Antares, Standard Nuclear, and NaturACU. So what are we watching for here?
We are watching for an allocation announcement naming specific companies. If they announce it, it is incredibly bullish for U.S. fuel security. It proves the infrastructure is being built.
And if we hear nothing, if it's just radio silent into the 30th?
Silence is a bearish signal. It means slippage. It means the program is falling behind.
Okay, that makes sense. Then we also have NexGen Energy and Yellowcake. Let's start with NexGen. Their AGM is also June 30th.
Yeah, and they've been guiding for a summer 2026 commencement for their Rook-I construction.
Which is backed by that Canadian Nuclear Safety Commission license they got back on March 5th.
Exactly. So the run-up to this AGM is a highly natural window for a major milestone announcement, either starting construction or maybe a new offtake signing.
Real-time supply-side data points. And then Yellowcake operates totally differently. They aren't mining, they're just holding physical uranium.
Right, and they're doing a $10 million buyback program right now. It's a 60-day program.
Aimed at closing the discount to their physical net asset value, or NAV.
Yeah, and the pace of that buyback is what we're watching. Sustained buying by Yellowcake is a very quiet, very bullish tell.
Because it means the company itself thinks the physical pounds of uranium are deeply undervalued.
Exactly. They're basically acting as their own arbitrage.
So synthesizing all this, these aren't just isolated company updates. NexGen, Yellowcake, the DOE, these are real-time indicators of supply-side confidence and the West trying to build out its infrastructure.
They absolutely are. But, while the West is desperately trying to build domestic fuel security, international supply is being entirely dictated by geopolitics right now.
Which is the perfect pivot to our geopolitical radar segment. Let's talk about Iran and the Sahel.
Let's do it.
There is a 60-day clock ticking right now. On June 17th, the Versailles ceasefire memorandum was signed.
Right.
And that opened a 60-day nuclear negotiation window, plus a 30-day timeline to restore commercial traffic through the Strait of Hormuz.
So the highest leveraged geopolitical input on the board.
And just reporting the facts of the memorandum impartially here, the Trump administration explicitly downplayed the requirement to destroy Iran's stockpile of roughly 408 kilograms of 60% plus highly enriched uranium, or HALEU.
Yeah, that disposition is being left as an open negotiating item.
So what does that actually mean for the uranium market? I mean, 408 kilograms sounds like a lot to a layperson.
It does, but mathematically, it's a rounding error.
Wait, really? A rounding error?
Yes. Even if you took all 408 kilograms of that HEU and fully diluted it down to commercial reactor fuel, it does almost nothing to dent the roughly 350 million pound structural deficit we have right now.
Wow. Okay, so the sheer volume of the physical shortage completely dwarfs that Iranian stockpile.
Exactly. So this negotiation, it affects the geopolitical risk premium baked into the spot price. It does not change the fundamental supply foundation.
It's sentiment versus actual physical supply.
Right. If talks go well, traders feel less panic, and the spot price risk premium deflates. If talks stall, the panic about the Strait of Hormuz returns.
So we are basically trading on fear and relief in the Middle East. But if we want to talk about actual supply disruptions, we need to shift to Africa, the Sahel region.
Yeah, this is where the actual fundamental supply issues are playing out.
On June 17th, a joint committee was established to try and reopen the Cotonou export corridor between Niger and Benin.
Which is critical because Niger is landlocked. They need Benin's ports to export.
And on top of that, you have GoviEx trying to renegotiate terms for their 100 million pound Madaouela project because the junta in Niger is demanding more royalties and state control.
It's textbook resource nationalism. And don't forget, the Somaire stockpile.
Right. There are 1,800 tons of Yellowcake just sitting there, physically unable to be exported.
Yeah, just stranded. So the overarching theme here is that African supply is now gated by sovereignty politics, not by geology.
Which has to terrify Western utilities.
It does. And that is why everyone is looking at Namibia as the Western-aligned alternative.
Yeah.
You've got Forces Metals operating there, and John Borshoff is actually taking over as permanent CEO on July 31st.
Okay, so we've covered Kazakh signaling, Iranian diplomatic risk, African resource nationalism. How does a listener actually measure all of this? How do these moving parts show up in the numbers?
By looking at the running diagnostic.
Yeah.
The divergence between the spot price and the term price.
Let's lay out the tape for everyone. For 5 straight weeks, the spot price has been stuck in a very tight band between $85.80 and $86.10 a pound.
Yep.
But the term price, the long-term contract price, is holding incredibly strong at around $95.
And if we connect this to the bigger picture, that $9 premium of the term price over the spot price tells you everything.
Okay, break that down. Why is that $9 so important?
Because the spot market is driven by financial players reacting to headlines, like the Iran ceasefire. But the term market is driven by utility executives trying to secure actual fuel for their reactors for the next decade.
So what is the core thesis test for this week?
Okay, if the Iran talks advance and the spot price drifts down into the low 85s because traders are exhaling,
Right.
but the term price holds at 95, that proves the massive uranium deficit is structural. It proves the recent ceasefire only deflated a temporary risk premium.
And what if they both soften? What if the term price drops too?
If both soften, the thesis needs a serious reassessment, because it would mean the utilities themselves are losing their sense of urgency.
So what does this all mean for the listener? Are they watching the spot price as a distraction when the term price is the actual vital sign of the market?
Exactly. The spot price is sentiment. The term price is the heartbeat of actual supply security.
That is fascinating. Okay, let's briefly recap the signals to watch before we head out.
Sounds good.
So Monday morning, we are watching Astana for any off-agenda chatter on Kazakh output.
Right, the 6,144-ton baseline.
Yep. All week, we are watching the Iran headlines, remembering that it's a risk premium play, not a fundamental supply play.
And then into the end of the month, the HALEU allocation and the NexGen catalysts.
Exactly. Which brings me to a final provocative thought for you, the listener, to ponder. Build on what we talked about today.
Yeah, let's hear it.
If African supply is increasingly locked behind resource nationalism and junta demands,
Right.
and if Kazakh supply is leaning heavily towards Chinese sovereign contracts, does the day-to-day spot price even matter for Western utilities who might be structurally locked out of those pounds entirely?
I mean, that is the multi-billion-dollar question, isn't it? If the pounds aren't available to the West, the spot price is just a phantom number.
Exactly. Something to mull over this week. Thank you for joining us on this deep dive. We'll be watching the tape right alongside you. Have a great week.